today. Michael Darda, chief economist and chief market strategist at MKM Partners, says that data, though, could be misleading. Michael's joining us now from his office in Stamford, Connecticut. Michael, I have a sneaking suspicion after talking to you, I'm still going to be cowering underneath my bed. But you know, we have to be realistic, obviously. So I was talking to Michelle Meyer about this at the beginning of the program. You had the July retail sales data, but you also had the consumer confidence report, which shows that people are nervous, especially after what's been happening for the past couple weeks.
Absolutely. So what we have really is a fairly mixed data picture. There was some data that came in above expectations this week, jobless claims and retail sales, as you noticed, or as you noted. But then we got that consumer confidence number, which was a disaster. This is fairly consistent with what you see at a turning point in an economy. Unfortunately, in the first half of the year here, we were basically at stall speed, which means you're much more vulnerable to a shock. So the slowdown that the U.S. experienced really came at an inopportune time in the sense that Europe now, with a potential banking and credit market meltdown underway, really could hobble the U.S.'s ability to pick up in the second half of the year as credit conditions tighten. So one thing we wrote about today was the Bloomberg Financial Conditions Index, which is just an index. The equity market's in there, but it has a lot of credit market spread indicators in there as well. It tends to lead the business cycle by 1 or 2 quarters, and that has really deteriorated dramatically.
We're looking at it right now. I just want to point it out to folks because we're looking at it right now. I mean, it's fallen off a cliff, essentially.
It sure has. And so the level of that index now, which tends to lead the economy by 3 to 6 months, is consistent with only about 3% nominal GDP growth, which is usually associated with about 1.5 percentage points of real GDP growth, or maybe 1.75 percentage points, which is very weak, not fast enough to generate the kind of jobs and income growth that'll pull that unemployment rate down and sustain spending. So I think it's appropriate to view some of the numbers today, i.e. the retail sales data, with many grains of salt and a lot of caution.
So, Mike, you know, you're the chief economist there. You're also, of course, the chief market strategist. And I think the question that people are asking at the end of this week is, what the heck do I do now? Do I look for safety? Do I expect that there are going to be more declines to come?
So we downgraded the energy materials and industrial sector in May of this year, and I'm still not optimistic on the cyclicals in terms of the S&P 500. So I would use large, days where we have large rallies in cyclical sectors to still lighten up. On days when the market falls dramatically, my preference would be to buy the non-cyclical areas like utilities and consumer staples, sectors that will hold up in a weak growth and/or recessionary environment, companies that have strong balance sheets and face inelastic demand curves. I don't think you want to be a hero in this environment. Unfortunately, we have a lot of potential headwinds that are bearing down at one time. Some of this is priced in with the big market swoon, but I'm afraid the ultimate lows on the S&P could be 100 points or so below where we are now, and this is something that will play out over the coming months and quarters, so it's not likely to end as abruptly and give way to the big market advances that we saw last year. Many investors seem to be using 2010 as the appropriate analogy, and I just don't think it fits the 2011 story at all.
So they're sort of overlaying equities last year onto this year in the economic scenario. I'm curious if you're looking anywhere outside of the equity markets right now. We've been talking about gold a lot. Certainly a lot of folks have still been piling into treasuries. What about you?
Well, the Treasury market actually worries me as an indicator of tremendous pessimism about future nominal GDP growth prospects. So even before the Fed announcement this week, we saw a huge collapse in Treasury yields. And not only that, there's been a very big compression in the term structure of interest rates. So the spread between the 10-year Treasury note yield, for example, and the 2-year note yield has collapsed from almost 300 basis points in February to around 200 basis points. That compression is typically associated with much slower growth ahead, and that's being corroborated by the big widening in high-yield debt spreads and other credit market indicators. So that worries me a lot about future growth prospects in the U.S. and these lofty earnings estimates for the S&P 500, which I think are going to have to come in, around 30% or so from where they are now. So I would say stay non-cyclical, stay defensive in here. Treasuries don't look look attractive at current levels, but that doesn't mean those yields are going to shoot up dramatically if the economy stays depressed.
All right, Michael Darda, we're out of time. Thank you so much, though, giving us some sobering perspective on what's going on with the economy and the markets right now. Michael Darda, Chief Economist and Chief Market Strategist at MKM Partners.